morning, everybody. Thank you very much for joining us on our webinar on the updated Academy Accounts Direction. I'm Nicola Mason. I'm a member of the Academies team here at MHA. So if I can run through what we'll be looking at today. As we know, the Accounts Direction is updated annually. So we'll be looking at what's changed in the latest update. And that's looking at disclosure information, some clarifications, and then we'll also look at some reminders in terms of the year-end process around the audit plan as well. And then we'll have the opportunity at the end for some questions and answers from you on the Accounts Direction and what we've covered. Okay, so just in terms of introduction and a summary of changes. Compliance with the Academy's Accounts Direction is mandatory for all trusts with funding agreements and open academies at any point in the period to 31st of August 2022. So it's the main document and the main legislation, I suppose, that's determining the disclosures and the format of the statutory accounts for Academy trusts. Last year was the first year it was split into 3 separate documents. So we had general guidance in the first document, which runs to around 95 pages. We've then got the example model accounts as Coketown Trust. Those include some example disclosures and further information about what is expected to be included in each area and all the notes and the reports as well. And we've then got the Auditors Framework, which runs to about 35 pages, which is guidance for your auditors and sets out some of the responsibilities in terms of the audit and also the work that's expected in relation to the regularity assurance report. That also sets out the evidence that the auditors are expected to obtain to support that report. So again, I suppose it's useful for trusts to have an awareness, and then they know kind of what to expect in terms of questions and evidence that's going to be requested by the auditors. In terms of what's actually changed, so there's 2 new requirements within the Accounts Direction, 1 clarification and 6 areas of information. I think that they've had this Accounts Direction that has been around for quite a number of years now, so the changes that they implement each year are reducing, but they do keep updating and amending because it's also a good source of kind of, I suppose, communication with the sector in terms of feedback. As part of the process in the Academy Accounts Direction, the ESRA do seek feedback from trusts and auditors, both on the Academy's Accounts Direction and the Model Accounts document. There is a link to the survey within the Accounts Direction on page 6. Which helps, so the feedback, I suppose, in the survey is to help the ESFA address any concerns or queries in relation to the accounts. So there are the 3 questions in the survey. So I've set out question 1 there, so that's in terms of how satisfied or dissatisfied are you with the Academy's Accounts Direction. So they have made changes in the current year as a result of feedback provided last year. So one of the things that they have included is some clarification around why the reporting in the accounts is different to the accounts return. Because there's often additional information requested as part of the accounts return process, and they've clarified that that's because it's the use of that information is for different purposes within their kind of accounting statements. So they are listening to what people are telling them and making changes as appropriate. So in terms of the Academy's Accounts Direction itself, that's kind of split into 3 areas. So we've got financial reporting requirements, again, which also highlights common issues found by the ESFA and gives them the opportunity to provide feedback on the accounts that they've reviewed as part of their review process. There's then a section that sets out in more detail what is required in each area of the accounts, going through the Trustees report, the governance statement, and all the different areas. And then at the end, from page 60 onwards, there's some more detailed and technical guidance on how to account for specific matters in the accounts. So there's kind of additional information in there around things like the different treatments for the different land and buildings arrangements that we find in trusts, treatment of donations in kind, and also disclosures and accounting for changes in structure. So where we've got new schools, converting and joining trusts, or existing academy trusts transferring in and out of larger trusts. So again, it's more of, I suppose, the areas that are different and unusual, and it just gives that bit of extra guidance around how to account for all of those. Just as well, there's also references and links throughout the accounts direction to some of the good practice guides issued by the ESFA. So these they've done these over the past 2 or 3 years, just to help academy trusts with some additional guidance around areas, and provide them some more information. So there's a list there of the things that they've provided additional information on. So things like the management accounting, which sets out in more detail what they're expecting to see, or what they're expecting Academy Trust to produce in relation to management accounts, and their kind of guidance on the oversight, how often they need to be shared with the board, and those kinds of information. Again, similarly with the internal scrutiny, I think that's changed quite significantly over the last few years, and again, it's more guidance on how boards should be determining or looking at what areas to look at for internal scrutiny and how that process should be managed. The new one for this year is the tendering jargon busting. Again, it's just a useful guide for trusts in some of the language that's used in tendering, and how to look at that and just kind of manage contracts in I suppose, more effective manner. But they are useful guidance. I think it's worth having a look at those as you're going through. So in terms of some feedback from the ESFA, so again, the ESFA is ultimately responsible for ensuring trusts operate to high standards of propriety and regularity. And as part of that, they carry out a review each year of the accounts, the audit findings reports, and also the internal scrutiny reports as well. So in 2020, there was 0.5% of accounts were qualified. So that was where the audit report is modified or unqualified. So the main reasons around that were for errors or disagreements, I suppose, in terms of the accounting for land and buildings, and also some instances of inadequate accounting records. In terms of the regularity report, there was a slight increase in modified regularity reports. So in 2019, there was 7.1%, and then in 2020, that went up to 8.5%. Of those, 14% of the modifications were directly attributed to COVID-19, around areas such as trusts not having independent checks of controls, because it was more difficult to have internal scrutiny visits completed, management accounts not being produced, and again, trusts not being able to hold the required number of meetings. So I would imagine the ESFA is expecting that number to come down this year. There was also a 1.2% decrease in emphasis of matter reports. So there's additional disclosure included in the audit report around material uncertainty due to going concern, which is positive in terms of levels of reserves and financial management. Okay, so in terms of common areas of irregularity, again, as mentioned, sort of management accounts not shared with the board with sufficient frequency and have been poor quality with inadequate information. So in the good practice guide, there is a detailed list of the information that is required to be seen in management accounts. That includes things like kind of a detailed breakdown of the balance sheet, in order that it can be managed effectively, consideration of KPIs, an explanation of variances in budget management. So there's quite a lot of information that is expected to be in there. Financial management generally, things like inaccurate bank reconciliations, concerns over value for money, lack of payroll authorization, and payments made without appropriate approval. So again, I think that's something that will need to be kind of addressed going forward, because I think basic controls and procedures are becoming increasingly important as we see kind of more fraud in the general community. Governance, so the GIAS not being updated, so that's getting information about schools and information not on the website or outdated information on the website, and also related parties, which is one that is quite common. So that's in areas of things like not obtaining prior approval, not considering the at-cost policy, and not dealing with conflicts of interest appropriately. I think it's important where management letter points have been raised in relation to some of those areas. It's important for trusts to be able to evidence that they have addressed those and made improvements, because those remain on the management letter and are updated and followed up for the following year, so can be reviewed by ESFA to evidence that they have been considered. Okay, then these are some areas of development that have been identified. So again, looking at establishing an audit and risk committee to agree a programme of work to address risks. So as part of that, I think it's important that the audit and risk committee has effective terms of reference, so that they're a clear outline of their responsibilities. And again, have also considered the internal scrutiny guidance in terms of making sure that it's driven by the kind of consideration of risk within the trust. And again, that a appropriate internal scrutiny programme has been developed, that there's an effective review and challenge of the findings, and also monitoring of the actions taken. Management accounts, again, making sure they have all the required elements, they're shared with trustees 6 times a year, and support appropriate board action. Again, I think it's also important to ensure that management accounts show effective, I suppose, challenge by the board, and kind of questions are raised and discussed in relation to those management accounts. In terms of the trust pecuniary interests, so it's the pecuniary interests of the trustees and the governing board that are there on the website, and again, they are kept up to date and amended. And then there's a sound internal control framework with clearly communicated procedures, appropriate day-to-day supervision with management checks. So again, that's the effective segregation of duties and oversight with approval processes in place and being applied to. Again, if you have anything in previous management letters, it's important to kind of follow those up. So this is feedback from some of the funding audits that the ESFA have undertaken. So the level of errors relating to census data and free school meal entitlement remains low. Any free school meals errors that were kind of identified related largely to the failure to retain evidence of entitlement. And I think one of the areas they picked up was the reliance on records retained by a previous school, rather than making sure that there's kind of valid evidence for the individual trust. Similarly, with bursary funds, that related to insufficient evidence supporting payments decisions and evidence supporting eligibility. To make sure that's retained. So I think those are kind of some of the areas that trusts should kind of review their policies and making sure that they are kind of keeping the evidence in relation to some of those payments. Okay, so in terms of the changes and new requirements, so the first one is in relation to the trustees report. So again, they must now describe the processes they have in place to manage conflicts of interest in the Academy Trust. And that also needs to include how they do that in relation to any subsidiaries. And it refers to the Charity Commission guidance, which is a link there. So that's making sure that the declaration of interest are completed on a timely basis, and a complete register of interest is retained, and again that's updated regularly and monitored just so that the finance team and other members of the SLT have knowledge of, I suppose, the any conflicts of interest that might arise, or the kind of organisations that it may apply to. Again, the handbook requires that pecuniary interests are included on the trust website, just to kind of have that transparency within the trust. Within the staff cost note, so there's a new disclosure requirement. So the values of any severance payments now must be disclosed in set bandings, and these are currently disclosed in the example accounts in bandings of 25,000. So this is in addition to the existing requirement to disclose the individual amounts of any special staff severance payments. So those are any paid to employees outside of statutory and contractual requirements. So we now have to disclose, I suppose, both different types of severance payments within that staff cost note. So if you have made any of those in the year, I think if you can retain the information relating to those, the approval process, the justification for those payments as well, and then just make sure we've got the disclosure information available. They've also, in terms of clarification, they've expanded slightly the requirements around the structure of the trust to include that it now requires a description of the structure of subsidiaries, joint ventures and associates. So I think we are seeing, I have a number of clients that do have subsidiaries that run things like the after school clubs or sports facilities separately to the overall trust. So included within the trustees report, we need to include the reference details, including the full name and charity and or company number. So it's level of ownership, of control. So it's kind of what is the involvement of the trust in terms of how that's controlled. If it's not wholly owned by the trust, the details of other ownership, an explanation of the entity's primary function, so effectively what it's set up to do, and an explanation of how that relates to the activities of the Academy Trust, and how the whole structure fits together. And then moving on to the kind of information requirements. So the accounts should reflect the circumstances and performance of the individual academy. There's a lot of example disclosures in the Coketown accounts, particularly within the trustees report and the governance statement. I think what the SFA are looking for is for that disclosure to be tailored so it reflects the position in the specific trust. They've also noted some kind of missing content from the trustees report and the governance statement. So things like action taken to review the effectiveness of the board. So whether that's an internal trustee skills audit or a full external review. So just in context, so a kind of review of the board must be carried out where an Academy Trust is preparing accounts for the first time, and as best practice, self-review should be annually undertaken. So that disclosure, it also requires the trust to disclose the actions that came out of any review and the overall outcome, and also what the impact of that has had on the trust. I suppose linked to that, and also not always included, is the detail of the work of the board in the year and what challenges they faced. So I think it just kind of gives an overall understanding of the overall effectiveness, really, of the board in the year. Again, where there hasn't been a governance review in the year, the trust needs to disclose when it intends to complete one. Where the board have met less than 6 times, so how effective oversight has been maintained, whether that's kind of regular communication or separate meetings of smaller groups. Details of the frequency of internal scrutiny, so how often that has been completed in the year and what they covered. And then also disclosure of both a salary and name of a staff member who's also a trustee. So some areas that the SFA have picked up in their reviews, which have raised concerns, is kind of where an academy trust has, they're aware that there's been significant governance, control or financial management issues, but these aren't reflected in the trustees report. The summary internal scrutiny report states that an area has been reviewed, but again, that's not disclosed in the governance statement. There's references to a number of meetings that aren't supported by the attendance numbers, so there's that lack of consistency in that disclosure. So I think it's kind of a careful review of that report just to make sure that it's tailored effectively for the trust and that there aren't any kind of inconsistencies around what we're reporting and that everything has been updated. Okay, they've also included a bit more information around accounting treatment of land and buildings, particularly in relation to the construction of free schools or schools under the Priority School Building Programme. So this is where the DFE is kind of effectively building a school on behalf of a trust, and it's handed over when it's completed. So the building shouldn't be recognised in the accounts whilst under construction by the DFE. And then if the site is being partially funded by the trusts, so any cost should be included as assets under construction and not be depreciated until the building is handed over, is in use. I've seen examples where the individual trust is responsible for purchasing the IT equipment, for example, within a building, so that sits within assets under construction. And then when control of the site is handed over to the trust, the opening value of that building will need to be recognised as a donation in the statement of financial activities and as freehold or leasehold buildings in the balance sheet as appropriate. And then depreciation will start from that point when the building is handed over and is in use by the trust. It's also worth considering when you're looking at that depreciation, whether there are different components in that building that will need depreciating at different rates. So things like boilers, lifts and things which may not last as long as elements of the kind of main building area. Okay, there's also been a change in relation to business rates. So previously, the kind of business rates costs were recorded and then the rates grant reclaimed from the ESFA. So from April 2022, for those billing authorities who opt in, academies will no longer need to pay business rates and then submit them to recover them. They will be paid, that will be kind of dealt with directly with the local authority, but we still need to reflect that transaction in effect in the accounts. So the GAG and the rates cost will need to be grossed up so that the cost is still accounted for. So we'll just need to know how much to gross up and include for that cost. They've also included some additional disclosure examples and narrative in relation to PFI contracts. So this is where there is a kind of a PFI contract with where the main contract holder is the local authority, but there is an agreement for supporting operating costs by the academy where that recognition is, that liability is recognised. So we also need an explanation, I suppose, what that payment is covering. So there's some example narrative there just in relation to explaining that this one costs is covering catering, cleaning, utilities and other ancillary services. But again, that will just need to be tailored for whatever the circumstances are for your individual agreement. Okay, just some other bits and pieces. So again, academy trusts are no longer required to submit dormant accounts to the SFA, but they must still be filed with companies' accounts. So this is a case where a trust has been incorporated as a company, but hasn't yet potentially opened an academy, or an academy transferred out of the trust so that it's effectively been empty for a full year. And in that instance, dormant accounts would be filed with Companies House, but we don't need to send them to the ESFA anymore. And it also in relation to teaching schools, it's no longer required to separately disclose the activity, but we need to consider, I suppose, the legal status of the activity. So is it a separate legal entity or is it part of the academy? And then if it is separate, there may also be an element of control that results in its inclusion within the trust accounts. If it's material to the trust, that will still need to be going as a separate line on the SOFA and in the notes. And again, we just need to consider the comparatives and how those are restated. This isn't specifically related to the accounts direction, but it's more just with the direction of travel. So in the budget forecast return for this year, there's a new requirement. So any academy trust that are holding reserves of more than 20% of income, excluding fixed assets and pension, they're going to be asking additional questions about the minimum level reserves required and also the reason for holding reserves. They're including, I suppose, a number of options that the trust can select, which including building projects, staff retention and development, overall strategic development, and future change uncertainty. So I think this just emphasises the need for clear reporting in the trustees report, and I'll come on to the current requirements around that a little bit further on. Just some reminders in terms of submission deadlines. So by the 31st of December, submission to the ESFA of audited accounts, the audit findings report, the accounts submission cover, and also the annual internal scrutiny report. They do tend to change the submission cover from time to time and include additional questions. I think one of the things they're looking at recently is asking for the number of related party transactions and then checking that against what has been pre-approved on their separate system, just to make sure that those tie up and are consistent. So it's making sure that the figures in the accounts and the figures on the submission return tie back to what the related party transactions are that have been pre-approved in the system. By the 31st of January, the published accounts need to be on the trustee website, and also by the 31st of May, those accounts need to be filed at Companies House. And just some reminders for, I suppose, the year-end process. In terms of the trustees report, I think it's worth noting that there's quite a lot of information within that trustees report, and it's a good opportunity for the school to demonstrate or the trust to demonstrate what they've achieved in the year, what the kind of overall, gives them guidance on the overall culture, and it's a good source of information, I suppose, for prospective parents as it's on public record. So it's important to kind of plan who will draft that wording and the information that needs to be included and start as early as possible. So that's ready at the start of the final audit. The trustees and the accounting officer need to be involved, obviously, because they need their input and the kind of the information from them as well. And the numbers from the statutory accounts in relation to things like the financial review and the reserves can be included at a later date once all that's finalised. As I mentioned, the reserves policy, so this just sets out the requirements around that. The overall policy for holding reserves, which I think that needs to be established by the trustees, is in terms of what the reserves should be kept for, and the ideal level in terms of what is appropriate. They then need to disclose the amounts and split of actual funds at the year end, so we can split out the amounts that are attributed to fixed assets and the pension to get back down to effectively what is the kind of free reserves. If there's any deficit funds, why they've occurred, and what steps are going to be taken to eliminate those. So it may be that there's been a kind of a large capital project funded by the trust, or the kind of or additional developmental costs in the year. And again, finally, so comparing the level of reserves at the year end with the ideal level as determined by the reserves policy, and what action's been taken to bring it in line. That could be from either direction. So if reserves are too low, how is that being addressed in terms of kind of budget management, or if reserves are too high again, why they're being held and how that will be reduced in future years. There's a couple of additional requirements in the trustees report once trusts get to a certain size. So for trusts with over 250 employees, we need to include the policies towards employees and disabled persons. I think it is worth considering or just being aware for trusts where the structure has changed, where we've got additional schools, just making sure that you've not gone over that limit with the addition of additional schools or changes. And then when companies, where a company meets 2 or more of the following criteria and becomes effectively a large company, we also need to include information about engagement with suppliers, customers and others in business relationship with a trust, and also the energy and carbon reporting. And again, there's a good practice guide in how to get hold of that information and include that disclosure within the trust accounts. So in terms of the regularity statement by the accounting officer, the trust should have evidence in order to provide that opinion. So things like minutes of meetings, internal scrutiny reports, financial procedures, management accounts, kind of all that information to support that conclusion. There's some information generally included in the annual letter that's provided to the accounting officer by the ESFA. So it's important to report all areas of non-compliance, split between kind of financial transactions and other weaknesses, and also include monetary values if they are known. And where there's going to be a change in the accounting officer between the year that we're reporting on and the kind of the time when the accounts are signed, it's important that the new accounting officer has sufficient evidence to be able to sign off that regularity statement. So it's again is ensuring that there is, I suppose, almost a file of information for them to look through, just to satisfy themselves that they are able to sign off that report. Okay, just again in terms of disclosures, the categories for group and expenditure are summarised within the accounts direction, so there's a bit more information and guidance on what needs to be included where. Again, that's also in the model accounts as well. And then we also need to disclose the method that's been used to allocate costs to both activities and also how the central costs have been allocated. So again, that may be relating to income levels, staff numbers, or those kinds of methods. Within the staff cost notes, as we said, the severance pay now disclosed in bandings. Any non-statutory or non-contractual severance payments, the individual amounts need to be included. Average number of employees by headcount, and then you can also include average number by full-time equivalent. And then disclosure of remuneration of key management personnel, and within that note as well. Management numbers should include the SLT who do not have day-to-day teaching duties, and the head will always be included in management. Okay, in relation to the related party transactions, so just to make sure that all trustees and key management personnel have completed the related party questionnaires. The guidance on related party transactions is on page 54 to 57. And also in relation to related party transactions, in accordance with the handbook, it's important to report all transactions to the ESFA now before they are incurred, and also obtain ESFA consent where the transaction or it takes the annual transactions over 20,000. Again, just make sure that they're in line with the financial regulations and you followed effective procurement procedures. And where any related party costs are over 2,500, that the checks are done or that the trust is satisfied that they are provided at no more than cost. Okay, in terms of the information required for the audit, so Trust will have a deliverables list, and Excel spreadsheets to complete to be ready by the final audit visit. So we'll kind of aim to agree dates as early as possible. And then where you can't provide that information, if you can inform us as early as possible, again, so we can discuss any assistance and potential fees with you as appropriate. Again, within the good practice guides, there is a full list of the information that should be prepared for the year-end process. So Trust can have a look at that. In terms of funds workings, for preparing the accounts, we need to allocate expenditure against each of the income funds. So we'll need to know what's been allocated or spent against the pupil premium, the bursary grants, the devolved formula capital, and again looked at the costs relating to some of the unrestricted income, so lettings, overall catering, and also areas to generate third-party income. So there may be elements of management time and other kind of central costs that need to be allocated against those areas. So in terms of the audit plan, so it's important to kind of discuss audit risks with the Finance Audit Committee. As part of our planning, we kind of review and have a kind of draft process, but obviously the Finance and Audit Committee may be aware of other risks that they kind of consider need to be reviewed. Any new bank accounts for which we will need to get bank letters, we just need to be aware that those have been opened so that we can request them. The audit plan then issued to the wider board, and then with agreed dates. So I think if you can let us know as soon as those autumn term dates have been set, and then we can plan the work and the around that, and make sure we're kind of meeting those deadlines. Ask any questions about the year-end process. So we're kind of ready to go. Complete questionnaires and deliverables, write the trustees report, and then upload information to the portal in advance of the final visit. Okay, so we'll move on to any questions and answers. Has there been anything shared in the question answer?
Yes, we have had some questions. So the first one was a question about whether the trust is compliant when they present the accounts 3 times a year. So I imagine the management accounts 3 times a year to the Finance, Audit and Risk Committee, and at 3 board meetings, because the board doesn't meet 6 times a year. So I know that in the Academy Trust Handbook, it states that when there's less than 6 meetings per year, the trustees have to describe in the governance statement in the trustees report that you mentioned earlier how that trust has maintained effective oversight of the funds if they're meeting less than 6 times a year. So there must be some other communication between trustees on those management accounts. And I think, the add-on to that is that obviously trusts should be aware that they need to share the management accounts monthly with the chair, and then 6 times a year with the board. So that can be done by electronic means. And also there has to be a way of trustees, challenging those management accounts, posing questions.
Yeah, I would agree with that, definitely. I think it's very much something that the SFA look for, is a demonstration of that challenge by the board of those management accounts. So I think that definitely needs to be part of the process.
Yeah, and I think it's one of those things that's quite easily forgotten to describe in the governance statement, isn't it? That there needs to be a sentence in there about how those trustees received the reports 6 times a year, the management account 6 times a year, and how they were able to communicate any questions and queries that they had on those management accounts.
Yeah, yes, definitely. Okay, is there any other questions?
Yes, so we also had a question asking about whether any local authority transactions would be classed as a related party. So we were kind of thinking it would depend on the actual connection between the local authority and the trustees, members and key management personnel of the Academy Trust. For example, if you had the chair of trustees was also the chair or in charge of the local authority, then yes, it would be likely to be a related party transaction. So it's about just thinking about what the connection is and recording that. Any other views from you, Nicola?
No, I don't think. I think that I would agree with that. I think it's not a. It's probably the question's probably arising to see whether it's almost an automatic related party, given that it's I suppose all linked into kind of central government. But yes, I would agree that it would depend on the individual trust and if there were any specific relationships between there. So yeah, don't think generally as a rule it would be, unless there was that kind of specific relationship.
Yes, and I think this is Bianca. I think there's also, people may be thinking of the AAR when, they used to, when you were completing the AAR after the statutory accounts were done, they used to have to disclose all the counterparty transactions, which included transactions with lots of local authorities. So that is different from the disclosures required in the statutory accounts as regard related party transactions, so that there may be a little bit of confusion there, perhaps.
Yeah, it kind of depends on the control, doesn't
yes.
it, between, with the connections as well. So thinking about where the control is.
And so, Nicola, there are no more open questions.
Okay, wonderful. Well, thank you everybody for joining us today. Obviously, if there are any further questions that you think of at a later date, our contact details are on the slides if there's anything further you want to ask. But otherwise, thank you very much for joining us.